Hey there, this is Ike Hoffman with Tactica Real Estate Solutions, and today we're talking about the yield on cost metric in multifamily real estate investing. This is the final video of a two-part series. In part one, we covered the definition, some of the common terminology you hear. We compared the yield on cost to some other common real estate metrics. And finally, I showed you how you can compare the yield on cost to market cap rate intel to ensure you are in fact getting a good deal. If you haven't seen video one yet, check that out first. The link's below. Part two is going to get a lot more granular. We're actually going to go into some of the Tactica proformas and look at how the yield on cost is used in a development deal, a value add deal, and a redevelopment deal, and hopefully give you some ideas how to enhance your analysis using this underrated and insightful metric. Let's get started. Let's start with a development deal. Before we jump in, I just want to remind you that there's a ton of terminology that gets thrown around. The yield on cost and the return on cost are the exact same thing. They strive to calculate a yield on the total cost basis that doesn't factor in any leverage. But for whatever reason, when I'm thinking of new development, I think of the yield on cost as a return on cost. I don't have a good reason for it. It's the people that I learned from refer to it this way, and I've continued to roll with it ever since. The yield on cost or the return on cost, it's arguably the most important metric there is in real estate development. A developer needs to know the market well. They need to know once they stabilize their development and sell it, that they can sell for a profit. So to do that, they need to know their costs. They need to know what their projected stabilized NOI will be. With those two variables, we can calculate the return on cost and then compare that to market cap rates. The higher the return on cost is above the market cap rate, the higher the probability that the developer will see a profit when they go to sell their investment one day. Let's start with a super simple example just to show you how this might look. We'll say we're in a market where newly constructed Class A, assuming that it's stabilized, right? The lease up is complete, it's 95% occupied, the expenses are normalized. We'll say that the market cap rate is 4.5%. Say the developer has some rough details. They know that it's going to cost $10 million to construct the deal, and the stabilized NOI is going to be $600,000. With those two variables, we can calculate the return on cost, just taking $600,000 divided by $10 million, return on cost of 6%. Then we can calculate the development spread. The development spread is the difference between the return on cost and the market cap rate. The higher the delta between the return on cost and the stabilized cap rate, the more likely the developer will reap a profit when they sell their investment one day. So we'll take the 6% minus the 4.5%. The development spread is 1.5%. We know that the project costs $10 million to construct. Assuming you could sell the $600,000 NOI at a 4.5% cap, would result in sale proceeds of $13.33 million. If you could sell the project for $13.33 million, you'd be in line to make a profit of about $3.33 million. Knowing that the return on cost here is 1.5% higher than the market cap rate is a good indicator that the deal is probably going to be successful, assuming that the market fundamentals don't change too significantly before you sell. But what if instead the market cap rate was a 5.75 cap? So we change this variable here. You can see the development spread now decreases to only 0.25%. And the value when stabilized would be about $10.4 million. If the development spread was only 25 basis points or 0.25%, would the risk of developing a property be worth $434,000? I'd guess not. I think you'd be better off going into the market as a buyer and purchasing an existing deal that's already de-risked. You're not taking on nearly as much risk when you are purchasing something that's already been built, stabilized, and generating income. Let's jump into Tactica's free multifamily development tool. This is Tactica's back-of-the-napkin development analysis tool. It's meant to be a very quick way to vet a deal before you plug in hours into more feasibility studies. It's really a great tool if you have a site, you have a land cost, you know roughly your hard and soft cost, what the rents would be, the operating expenses, And then it can give you just some rough metrics on whether or not the deal can pencil. You can see there's in the bottom right-hand corner, after everything is calculated, there's only one graphic in this entire workbook, and it compares the return on cost to the stabilized cap rate. This means that in this particular example, a developer could build the project for about a 7.52 cap, and then once it's completed and stabilized, they could go sell it back to the market at a 5.25% cap. This would be a great project to potentially plug into a more sophisticated model, which we're going to do here soon, and vet it further to see if this potential is warranted. Now let's look at Tactica's development model. I have a couple cells in the project level return section dedicated to the return on cost. First, there's a return on calculation. Second, I'm calculating the spread over the stabilized cap rate today. And lastly, I'm also calculating the spread over the residual cap rate in year 7. In this particular pro forma, I'm assuming a sale would take place in year 7. Let's look at these calculations a little deeper. So how most Tactica models work is the model usually asks you for a stabilized cap rate today. So you can see it in the actual development model. I have plugged in 5.25%, and then there's an increment per year. Why I do this is conservative underwriters will typically increase the residual cap rate every year that they hold the investment. They'll do this so the returns in the pro forma aren't heavily dependent on just a high residual value. And it can kind of skew the returns to the high side if you're using a overly aggressive residual cap rate or a lower cap rate, which shows the deal having these massive sale proceeds at the end of year 5 or year 7 in this example, or even year 10 if you're doing a longer term hold. It can really lead to your project being dependent on the capital markets, things you don't control, continued cap rate compression or cap rate staying the same, when ideally the whole reason we're doing these pro formas at all is to ensure that we're vetted, we're comfortable with maybe the market not being in the best shape when we look to sell it in 5 years or 7 years or 10 years. So that's why personally when I'm underwriting something, I will always have a cap rate increment. So in this example, we're increasing it by 0.1%, which is 10 basis points per year. So I'm just going to plug in some of this information in our Excel workbook off to the right, and I'm going to redo these yield on cost calculations, just keep them incredibly simple, because sometimes they get lost. They get buried in the logic of these more complicated, complex, thorough models. It's easier to see what's actually being calculated if I keep it really simple and can cut out all the if statements and dynamic logic that these models depend on. So I put in 5.25. I'm going to put in 1.1%. And you can see that the residual cap rate, then it's tracking. Today it's a 5.25 cap, and it's going to go up every year. So in our model, if we were to sell in year 7, we're saying we'd sell at a 5.95 cap, even though the cap rate today for this type of product is a 5.25 cap. The stabilized NOI, we need to get that from the model. So I'm going to go to the stabilized operations tab. You can see here the NOI after reserves is 2.456 million. So I'm just going to hit equals and grab that directly from the model. And then the total cost. How much is it to build this? The hard costs, soft costs, financing costs, marketing costs. To get that, we'll go to the budget and draw tab. We're just going to grab it right from the summary at the bottom, the 32.6 million number. And then the rest of the model will populate. So we can see here in the project summary tab, the return on cost was 753. It's calculating here as a 753. At glance, it looks like this could potentially be a lucrative development. The market cap today is 5.25. And the numbers that we have for our stabilized NOI and construction costs shows that we could build this for about a 7.5 cap. The 2.28% is the difference between this 7.53 and the 5.25. In the model, I'm just presenting it as basis points, but it's the same thing. So 227 basis points or 2.28%, they mean exactly the same. But I also have a spread that's calculated in year 7. Remember, I'm assuming a 7-year hold in this scenario. So it's not only important to calculate the return on cost or the yield on cost today, but we need to do that 7 years out to just make sure that there's still a bit of a cushion between our construction cost, between our construction yield, the 7.53%, and that cap rate potentially decompression that we may see if the market conditions deteriorate in the upcoming years. So here we still have a 1.58%, which still feels really good given that this is 7 years out from today. So in summary, in the development model, we're calculating the return on cost, and then we're benchmarking that return on cost against the stabilized cap rate today. This is your development spread today, the 2.28%, and then how that would look 7 years from now when we would sell the asset, and it's a 1.58% spread. This metric is so important. I have an entirely independent analysis dedicated to it in the stress test section. So I'm going to go ahead and make this big for a second, and I'm going to turn in the bottom right hand corner is our return on cost stress test. So you can see here in the middle of this grid, our construction cost of $32.6 million and our projected stabilized NOI of $2.456 million. This is what's in the model currently, but you can see how the return on cost will change at different construction levels and different NOI levels. This is a nice analysis to show you how things could change in this return on cost calculation if the NOI changes from what your initial projections were or your construction budget is over or under what you had initially projected. Let's next jump into the redevelopment model. So in the redevelopment model, I have the stabilized yield on cost metric highlighted blue because it's so important. Right below it, we have some cap rates. We have a T3, T12 cap rate. We have the same cap rate but adjusted for real estate taxes, and then a stabilized forecasted year 3 cap rate. I'm going to again minimize this screen a little bit so we can get our other workbook up and work through some of these calculations. So like the example we just did for development, there's a lot of the same logic and thought process that will get duplicated when we're talking about an existing deal. So redevelop to me means that it's a property that's distressed. Maybe it's had a lot of vacancy, maybe there's a lot of deferred capital, but you're going to need to plug a ton of capital into it to fix the property and make it enticing for your potential residents. But you should also see a significant increase in NOI, either through rent growth or expense cutting. So we need a market cap rate today. So just as in the development example, we had a cap rate today assumption, and then we were increasing that cap rate every year as a conservative underwriter would do, so the residual value doesn't get overstated. We're following that exact same logic. So if I scroll over in the redevelopment model, we have an assumption for a cap rate today. So if this deal wasn't distressed, if it was fully occupied, getting good rents, expenses were in line with where the comps were, we're saying we could sell this at a 5 cap today. So I'm going to plug in 5% here. And then just like the development deal, we're doing a 10 basis point increment per year. I'm going to plug that in. And then our stabilized NOI. In this particular example, we're assuming that the renovation is going to take 2 years and the NOI won't stabilize until year 3. So I'm going to go the return summary, and that stabilized NOI is $993,743, so almost $1 million. You can see how much it ramps up between years 1 and 3. It starts at about $500,000, gets to $820,000 in year 2, and then $993,000 in year 3. So I'm going to grab that directly from the model. Then total cost. What's the purchase price plus any renovation capital, deferred capital, financing fee? So to get that, we'll go back to the investment summary tab, and we're going to scroll back over to the very left. And you can see there's a nice sources and uses summary. We can see the purchase price is $13.5 million. We're projecting about $1.33 million of CapEx. There's some closing costs. There's construction financing costs, and then in this particular deal, the sponsor would charge an acquisition fee. So all of these costs equate to $15.158 million. So I'm going to grab that. I'm just going to hit equals minus. And there we go. It's calculating the yield on cost for us. Just want to hammer home one more time. This terminology is synonymous. Yield on cost, return on cost, they mean the exact same thing. Me personally, if it's an existing project, I tend to call it the yield on cost, where if it's new development, I'll call it the return on cost, but they mean the exact same thing. And I'm just noticing now that I'm increasing the annual cap rate by 1%, but it's supposed to be 0.1%. So let's just update that quick. Okay, now things look much more normal in the rows that follow the return on cost. So we can see in the redevelopment model, the yield on cost 656, the return on cost here 656. The development spread today, so looking at the return on cost minus the market cap rate today is 1.56%. But let's look at that again in year 3, right? Because the property won't be stabilized until year 3. We're not going to be able to get through all the unit renovations for quite some time. So really, that cap rate today is irrelevant. And as an extra safety check, it may make more sense to run that development spread calc on yield on year 3. So if we take the 656, remember we're increasing by 10 basis points a year. So we'll go to 5.1, 5.2, then 5.3. Still have a fairly healthy yield of 1.26%. If we can sell our stabilized NOI in year 3 at a 5.3 cap, that would equate to almost $19 million in sale proceeds. If we compare the sale proceeds in year 3 to the total cost it took to stabilize this property, we have a gross profit of $3.6 million. The final example I want to walk through is in our value add model. We're going to plug in a renovation plan, but as of right now, we're running a $0 premium and $0 of capital, and that equates to a 10-year IRR of 12.14%. So if we go back to the renovations tab, you can see the renovation metrics are summarized in this section here. $0 premium, $0 capital spend. Calculation. What's interesting with the yield on cost calculation is it can also be used to evaluate individual elements that make up the big project. So in the last 2 examples, we're kind of looking at the entire project and seeing if, and using the yield on cost to justify if our capital plan and our pro forma budgeting for the NOI makes sense. Is it going to be a profitable deal? Are we getting a good deal when we compare it to market cap rates? But it also works really well for the small components that kind of make up the larger deal. So in this example, I'm going to show you a few different examples of how we can use the return on cost. Again, the terminology, when it's these little when it's the smaller components of the deal, I also refer to return on cost. Don't have a good reason for it. It's just how I learned it. And kind of show you how we can compare this to the IRR to determine if it would make sense. So the IRR the 10-year IRR was 12.14%. All right. Right now we don't have a renovation plan, but let's go ahead and say that the premium is $75 and the capital spend for each unit is $10,000. So you can see that data updates. So for each unit, there's a premium of $75. There's a capital spend of $10,000, which equates to a return on cost of 9%. The return on cost for all units blended, it's the same, right? Because we're just running the same numbers for all the different floor plans, is less than the IRR. While our IRR was 12% before, it's now going to drop to 11.65% because the return on cost of this value add plan isn't accretive to the returns. It's lower than what the IRR was before, so it's in fact hurting our total return by doing this renovation. If instead we used a premium of $150 for every unit, and we'll leave the capital spend as the same, now the return on cost jumps up to 18%. Blended, it's the same. And our IRR will increase to 14.1%. So in summary, because the return on cost this time is higher than what the IRR was with nothing planned in for the renovation scope, it's going to drag that total return up. So this is a great way to evaluate the individual projects that you'll need to take on as an owner to determine if they will in fact help your total return. The question you need to ask yourself, is the return on cost greater than the overall IRR? If not, the project is going to drag down the IRR. If the return on cost is greater than the total IRR, the IRR should increase. So as you can see, the yield on cost metric is very beneficial when evaluating the individual elements and decision-making processes of a project. Now, obviously, sometimes you just need to fix stuff and there's not going to be any return on investment, and there's really no analysis that goes into just taking care of deferred CapEx. Other than that, the next ownership group will punish you if you don't take care of it when you go to sell it one day. In summary, all of Tactica's multifamily pro forma models incorporate the yield on cost metric in some capacity. It's a creative metric, it's practical, and it has a special use in varying business plans. Thanks so much for tagging along. This concludes the two-part video series on the yield on cost. Just as a reminder, check out video 1 if you haven't yet. It provides just a more solid footing and foundation for understanding the yield on cost metric. And there's also a free template that I featured earlier in this video, that back of the napkin multifamily development analysis tool. You can get that for free right from the Tactica website. Just need to enter in your email and it will be sent to you in short order. I hope this was an insightful video and I hope you can use this metric in your real estate analysis. If you have any questions, feel free to comment below. Take care.